Thank you so much. So we have about 25 minutes for what will, I think, be a very robust conversation. So we'll do the same approach that we did before, but I do want to just encourage folks to remember that you will have time over breaks to have dialogue, that breaks are important, and so keep your comments reasonably concise, your comments and questions, and we will make sure to have some closing time for all of our speakers at the end. So please, go ahead. And please do introduce yourselves again and stand up for the people on Zoom.
Okay, great. I mean, I'm starting. I didn't mean to hog it, but anyway, thank you.
Stand up and
Yeah.
introduce
Oh,
yourself.
sorry, I'm
You don't have
Jayati. Yeah, hi. Okay, that was a great session. Thank you so much. And I have a question that is kind of interconnected. But to Kevin and Marina, you talked about how you're saying the DSA doesn't factor in. I mean, it brings in climate shock in terms of what it does to the GDP. But what we find about climate shock is that it actually adds to the interest rate. In other words, it dramatically increases spread, right? I mean, whether it's Jamaica or Pakistan or something, the minute you have something terrible, spread goes up by, I don't know how many 100 basis points. And I wonder if that is factored in. I know the IMF doesn't. But if you'd factored that in, would that change your projections as well? And this is kind of selfishly asking Marina to repeat some earlier research you've done. If you can just tell everybody about that. This bears on what Avi was talking about, and I think even Daniel was suggesting, that the whole idea of the risky countries, and you have done some really good work which shows that even the countries that are described as being the riskiest and who are currently facing deep debt distress and are approaching the common framework and so on, in fact, long-term investors have got a much better deal than they would have if they had invested in US treasuries, right? So I would, just if you can share that, because I think it's an important thing for everybody to know.
Everybody remembers me. I didn't introduce myself in the morning. I'm going to do it now. Leon Sdikumana from economics. Excellent presentations, everybody. Kevin, one of the numbers you're showing in terms of the increasing burden of debt for developing countries is frightening. And I want to just remind people that it's actually not new. People may think this is COVID, this is no, even before COVID. Regarding the burden of interest payments, which has been worsened by resorting to private forms of credit. I remember when African countries began to go for sovereign bond and loans and so on. It was actually celebrated as a measure of success, that the credit rating of these countries had improved. They were seen as safe borrowers, and therefore it was a mark of success until you see the consequences. So as we are talking about expanding scopes for mobilizing resources, what would countries do? Should they not go for private loans? If not, how do we increase the sources of concessional cheap loans beyond what we see now? Because I struggle to see the World Bank's African Development Bank in Latin America lending tripling over the next 10 years.
My name is Shovik. I'm a researcher at PERI. My question is for Avinash Prasad. One of the arguments, which, if I got it correctly, was to give debt to this risky countries, which is seen in the global financial market as risky, so as to give it an anti-cyclical thing. But many of these countries, like suppose India, has a FRBM Act, where they are not allowed to increase their deficit or increase more debts. So I was just wondering whether the constraints or such acts would create a problem in getting more debts, even though they are given out at low interest rate to these economies? Thank you.
We'll do the back and then we'll come back up.
Hi, I'm Leo. I'm a second-year PhD student here in my second PhD. But I had a question for Kevin and Marina. I'm from Argentina, by the way, so this conference is great for me. So I was just looking at your paper, and you mentioned that one way to sort of share the burden of debt between creditors is use this fair rate instead of a flat rate. And considering that most of the low-income countries tend to be very specialized in raw materials or some primary sector activity, the exchange rate, I think, is crucial in terms of how these countries are integrated only sharing in the losses, right? So I was wondering if you had any ideas of how to think about the exchange rate or exchange rate policy or management so that the integration is not just, prejudicial to developing economies.
I think we have two in front.
Yeah?
Yeah.
Yeah, Isaac Diwan. I have maybe three quick questions. One for Avinash. This counter-cyclical role of MDBs, which would make a tremendous difference in stabilizing, developing countries' macro. For you, does it have to be big enough to also bail out their creditors, private creditors that want to pull out in bad moments, or not? It would have to be, tremendously powerful if it also does that. Then for maybe all of you, we haven't talked in this session about blended finance, how to support FDI that would go into mitigation. Do we believe this is feasible given all the demands of the private sector and all the kind of guarantees that they're asking for? And then very quickly, Danielle, you spoke about the contingent claims in the Zambia and other deals that we're seeing, which are really squeezing developing countries in paying the maximum they can in every state of the world. You would think that countries should be able to bargain to pay more in the high state or to pay less in the low state of the world, but somehow we're seeing maximum payments in all. Why are we getting there? Is the bargaining situation totally unbalanced?
Right behind you. Okay.
Yeah, Ahilan from University of Jaffna. Just a question to Kevin, Marina, and Daniel to kind of bring what you are saying together and what was discussed in the morning about like a debtors club or coalition of debtors, right? So if you look at what you guys first showed about if the rate of interest is higher than growth, it doesn't make sense, or some measure of that, and then you combine it with like the net transfer of debt, right? Is there some way to have like a kind of like an index where at a certain point, a set of countries, it would be a red flag to not go to the bond markets, right? So that given what the interest rates, so if you can, so both for countries that have defaulted, but also for countries that where the kind of interest rates are, is there a way to make some kind of a index or a red flag so that beyond this point it doesn't make sense? So you collectively take action or you collectively negotiate with, or you say that you're not going to go to the bond markets until those interest rates come up so that you have some bargaining power.
And this is to, I'm Chandrasekhar. This is to Avinash. I'm just wondering, what determines the fact that, current fact that MDBs have AAA ratings? Is it because of the fact that the countries, the donor, or whatever, the advanced countries which put their money through the multilateral development banks, provide it with an implicit sovereign guarantee that there will be no way in which they let the MDB default on any of its liabilities? Or is it because of the fact that by treaty, every country which borrows from an MDB is required to pay up, and therefore an MDB will never accept a haircut? Now, if it is the latter, given now the pressure that MDB should also take a haircut, and given the fact that you're suggesting that there shouldn't be limits on how much MDB should borrow, because you need to get to these trillions, then can the AAA rating of MDBs be sustained?
Last call. Daichi is going to close us out. And we'll go to her.
No, just very quickly, Avinash, on your counter-cyclical thing. I mean, you mentioned, that this is really how it should be. But last year, we've seen that actually net lending is pro-cyclical from the multilateral development banks. So first of all, why was it so pro-cyclical? And do you really have expectations that it will change?
Great. So we'll give about 3 minutes each to our speakers. Feel free to respond to what you can. Yes, and then we'll continue the conversation after that. So.
Great, Marina and I will split some of these up. Jayati, we were being, in this particular study, we were being very conservative because it's so aggregate, and the impacts of some kind of a climate shock on the cost of capital really vary across the country. But we have another study on our webpage where we worked with the governments of Colombia and Peru and have done DSAs for them, and we use what their actual increase in the cost of capital was. And so we did that there, but that's not in this. That is another flaw. And when Avi's saying that they do climate shocks, it's implicit. They don't actually say how many you might have or what would happen if you had them. And so the two big things, we totally agree with what Avi says here, and that's what we do here. One, a DSA is automatically rigged to the level of austerity that you were at in 2019, and all these other fiscal consolidation things happen to keep you getting there. So number one, what we do and what they need to be reformed to do, at least in at least one scenario, is on what are your optimal resource mobilization needs, but then also what is your ability to respond to different shocks, and that's what we tried to do there. Leon, so great to see you. And when you said, why did countries in your region go to the capital markets, there was a sense of pride. One, it's a part of institutional development, but two, the rates were so low, right? And so it wasn't such a terrible idea. But there wasn't a lot of learning, and there was certainly no teaching, right? Almost every country in Africa had a IMF program during the entire period, and it was therefore illegal under the contract to have any kind of capital flow management measures and and the advice that you get under an IMF program on how to manage your capital flows bakes in this entire capital flow cycle, and so it's blind to that. I'm not going to blame it all on the IMF. It's more the Fed and everything we heard earlier this morning. But now the whole thing is different because rates are so high. There is that euphoria in Washington last week. Benin, Ivory Coast, and Kenya. The people were saying that that's a great thing of more things to come. And to me, it's not abandon the capital markets, but to get what Ahilan said, if I pronounce your name correct, you need to be more sophisticated about what the weighted average of the cost of capital of your entire capital stock of your entire foreign exchange is relative to some kind of meaningful idea of what your growth rate might be. And so what the World Bank does do that for licks, interesting to try to calibrate that across a bunch of countries, and if it gets to a certain level, then they all strike. That's interesting. But I just want to underscore what Isak said about the countercyclicality. It would have to be huge. There's a great article by Ugo Panizza that shows that the private capital markets are, of course, very pro-cyclical. Only the World Bank is counter-cyclical. All the other regional development banks are not. That goes up till about 2020. But the thing I said this morning, which is so important here, is that the biggest way to get out of all this stuff is growth and a new growth path, not the kind of growth that got you all this trouble in the first place. And the new literature shows that the multilateral development banks are not associated with growth. And so it's not just net inflows. It can't be a shot in the arm. You have to get a country back on a growth path, and that seems to be the big challenge.
Well, I will start by the bondholders' question. Thank you for raising this point. So last year when we were doing our report for the project, I actually found it was a document from Bank of America, actually, as a communication to creditors, and explaining the rationale behind how much they price for the clients, how much they charge, you know, if you are a AAA, how much is your cost of default, if you are, you know, B minus, how much should the premium be to compensate the cost, and they put it very clearly that they do pricing, bondholders, they do price for the cost of default. But at the same time, and what we saw, what Daniel showed as well, is, but when it comes to debt relief negotiation, the private sector, they are senior, right? They not only receive faster, but they receive more, the debt relief is lower. So we, in the blog that is called The Winner Takes All, that I'm happy to share with you all, we did some comparison of how much bondholders would, you know, have returns if they have invested, for instance, in the U.S. Treasury, which is, you know, risk-free asset, and how much they win, you know, as compensation of this supposed risk for developing countries. So in the case, for instance, in 2015, when this Zambia, Suriname were issuing capital in the bond markets, bondholders would required about 2% interest rate to lend money to the U.S. Treasury. But for Zambia, Suriname, for instance, they charge over 7%. The problem is, when we calculate the cash flow of the new bond after that relief, actually the cash flow for Suriname was over 9%, and the cash flow for Zambia was over 8%. And why? The negotiation was obviously longer. Because they calculate by the net present value, you accumulate arrears over a period. So even if you reduce the nominal, right, bond, it's not enough to compensate this very high interest rate. So what you can see is that actually bondholders, they are not assuming the risk of what they have charged in interest rate ex ante. So this goes to the question of the comparability of treatment, right? So if we know that some creditors, they charge for the risk of default and other creditors, no, doesn't. You need to, when you go to debt relief, you need to balance this cost. So bondholders should assume a higher debt relief, which they are not in this moment. MDBs, in the cases of creditors that need to be part, because they give very high concessionality, they should bear a smaller amount. So we need, the idea is just to compensate to the risk that creditors give. So this is the idea of the fair comparability of treatment that we put in the report. And your question, should we assume exchange rate and other accounts when we look to comparability of treatment? I think looking to other factors are important, but it's very important when you go to that negotiation that you try to be as simple, as fair as possible. And I think adding, you know, maybe exchange rate, some creditors say you need to look how much the new investment generate growth in your economy. They are valid points, but I think for, you know, a straightforward and simple debt restructuring, maybe focusing on the interest rate could be something key. But you can discuss further this point. And finally, just the point of the debt sustainability, as Kevin said, the LIC DSA, they have the traffic light system where they should adjust the cost of new lending when countries are with high probability of debt distress. The problem in the case of the IDA is that IDA is limited resources, but this hints to the fact that debt sustainability should not only be, you know, should be an instrument to all creditors and to donor countries. So if a country is heading towards, you know, debt and sustainability, maybe they need more ODA, maybe they need more access to exports, maybe they need, you know, more affordable finance. So I think the role of the debt sustainability should be broader and should be in count also to the possibility of donors and other creditors to support developing countries. Yeah. Thank you. Yeah.
Thanks. On the issue of the contingent instruments, I think a good starting point on this is the remarks by the Secretary General of the UN, Guterres, on the fact that, the reason why we need a reform of the international financial architecture is because at its heart, it retains a colonial nature in itself. And a good example is how the negotiations take place, because the negotiations still take place as they have been taking place for the best part of a century, where the debtor country is invited to Paris. They go to the Ministry of Finance of France, and then they say, well, this is how much we need. And then the creditors listen and say, okay, thank you. Please go to this side room. Wait until we decide what you get, and then we'll call you once we have decided. And we have a good example of how that worked out recently, because Zambia negotiated a deal with its official creditor committee under the common framework. Then they negotiated a deal with the bondholders, and Zambia was very happy about the fact, look, we managed to secure an agreement, and they basically found out through the press that the official creditor committee had pushed back on the deal that they had reached with private creditors, to the point that when the press reached out to Zambia Ministry of Finance, they said, well, we cannot comment because we haven't heard about this. So it was purely an entire intercreditor dispute. And I think the fact how this is playing out is that there is an implicit trade-off that is taking place between non-Paris Club creditors and bondholders, in the sense that for bondholders, the most important thing is cash and and to minimize as much as possible the NPV losses of the restructuring. The most important thing for non-Paris Club creditors is to avoid outright haircuts. So then there is been the use of the contingent instruments facilitates this, because it allows both sides to basically come up with a good deal from their end. The problem is that nobody's asking if the countries actually have the amount of resources that are required to meet all of these additional cash flows. Because on the side of the bondholders, the issue is that contingent instruments are not a problem per se, but if you design the triggers in such a way that the likelihood of them being activated is pretty high, then it's pretty clear that there is an incentive to say, well, this is the deal, but actually, wink, wink, the real deal that you're getting is this. But because the three mechanisms to assess comparability of treatments are based on the baseline deal, so then it allows bondholders to get more get more cash, and then when non-Paris Club creditors say, well, fine, we're happy with that, but you need to also ensure that we're not going to get an outright haircut. And then the problem is that because of the post-default interest accrual, developing countries that are in default do have an interest to try and close the deals as fast as possible. And if you look at the evolution of deals, and I'm going to finish with this, the evolution of proposals in Ghana, in Suriname, and Zambia, and how they evolve through time, you can clearly see that the benchmarks all tend towards the proposals originally put forward by private creditors, and away from the proposal. Like talking with people that have been involved in these things in DC, when the advisors of the deals complain about what the bondholders are getting, then you know that something is clearly not working out.
Great. Please, Avinash, close us out.
Yeah, just for that last point, it's very important in negotiations where possible, you have to not need new money. That's the big negotiation thing that the creditors hang over you. They say, you settle now, quickly, we'll lend you some more money. In our debt restructuring, we made sure we didn't need any new money. And so when they said they could offer us new money, we said, that's okay, we don't need it. And it allowed us to get a 33% NPV haircut. It's interesting how we've all come back to very similar, the stalwart issues of development and development finance. It's about shocks and sudden stops and cyclicality and pro-cyclicality. Jayanti, you're quite right that in the crisis, interest rates go very high, and that's why we actually found the hurricane clause, disaster clauses being really quite significant. Because basically what they do is you defer your principal and your interest for 2 years, and it's added back on, but it's added back on later at the same interest rate as you began, not an emergency interest rate that you would have over a crisis. And then the scale of those things are huge. If you have if an issuing government puts it in all of their bonds, they get relief on, they get 20% of GDP liquidity in 2 years. What's being offered by the private sector and by the MDBs is 2% here, 1% there. That doesn't really give you the liquidity you need in a crisis. Risk premiums are high, yes, but that doesn't mean to say that you could sit there and earn it. Because those risk premiums are partly a function of the volatility, and many people can't withstand that volatility. Most of the private sector, for example, has very limited capital. So that's one of the reasons why they stay away from those things. So just because we see observable high risk premiums, it doesn't actually mean that if only people saw the high risk premiums, it would lead money to come in. Yes, it would be great if if we didn't have to go to the private markets and we went to multilateral development banks who lend to you at their AAA rated rate and a bit higher. But development banks today lend about $120 billion per year. We need $5 trillion for the SDGs, and they're lending $120 billion a year. So yes, maybe we can double them, maybe we can treble them. And that's what we're going for in our campaign. We want them to be 3 times bigger. But even then, you're still going to have to rely on a variety of other sources of money, and it wouldn't be ODA. So the idea of a counter-cyclicality is how do we give assurance to overseas investors in developing countries that they're not going to get the wrong end of a cyclical collapse. And so by offering counter-cyclicality only at these extreme points, the amount you have to offer in size is much less than the total investment that's coming, and being reassured that they can be refinanced over the long term. You're not giving a subsidy, you're not giving a bailout, you're giving a longer term refinancing. And I think that creates great leverage. Let me end with the point on blended finance. There isn't enough blended finance in the world for blended finance to be a scalable solution. If you need $5 trillion, how much blended finance do you need? $500 billion a year? You're not going to get that. There isn't that available. The amount of how much blended finance has there been in, despite all the talk, how much blended finance has there been? Probably less than 15 billion a year. So blended finance to me is a non-scalable solution. The reason why AAA rated banks, multilateral banks have AAA rated, it's both things. It's the amount of callable capital, actual capital, their extreme conservatism, plus the PCS. And the PCS isn't the only reason. They have a lot of capital. They're very conservative. That's why the CAC review says they can lend twice as much, even with their existing capital. And so we can get them to be lending more without changing their AAA rated status.
Great, wonderful. Well, let's join together and thank our speakers. Thank you so much, everybody. Great discussion. We will be back here at 3:15, right? So we have about 20. Oh no, we have 2:45. We were supposed to finish. We're a few minutes over. So 3:15. There are more refreshments back in the atrium. Please do throw out your trash. Take it with you and throw it out. And thank you. See you soon.
Thank you.